Hey everyone, today I am sitting down with Greg Burns, who I've known for going on 15 years. And Greg has helped hundreds of investors 1031 exchange. He's a senior vice president with IPX1031. And we just want to sit down with Greg, get an update on the market, and just talk 1031 exchange and what we need to know on completing exchange, and then most importantly, thinking ahead before we do an exchange. What do we need steps ahead of the process to prepare? So thanks so much for being here and sitting down with us.
Yeah, thanks for having me. I look forward to having a little chat about 1031. We certainly have done enough of them.
Yeah, no, absolutely. I mean, you're the go-to. And first off, before we kick out the video, we really appreciate when we do have an investor who's thinking about doing an exchange and they want to get some front information. We can get them in touch with you, and you're very accessible and very knowledgeable, so we really appreciate everything.
Yeah, it's my pleasure. Listen, I love to talk to all your customers. It's important to go into the process and understanding how the process works so that you don't run into any speed bumps and everything goes smooth.
Absolutely. So just to start off from the top, you're with IPX 1031. You have been there for a number of years. You're a specialist, but you guys do a lot of volume. How much typically in transaction volume on a number of 1031 exchanges, say last month, are you completing?
Yeah, so last month we did a little more than 300 transactions in our Southern California office. We're a national company, so we're owned by a large title insurance company. We have 16 offices across the country. We're a qualified intermediary, an accommodator, facilitator, and so the volume is still very good. We're still seeing a fair amount of volume in the market where people, investors need to exchange certainly, and we're seeing them still come out in numbers and get things done. Obviously, going into the holidays, you see people taking vacations and enjoying time with their family, but actually November was still a really good month for us.
Okay, great. So just to dive in, we as investors know, most of us know that when we complete a 1031 exchange, we've got 45 days to identify a property and then 135 days thereafter to close escrow on the property, a total of 180 days.
Right.
And to defer the capital gains, we need to purchase property equal or greater than in value. So a lot of folks know that, but I think it's really important. We deal with a ton of investors that are doing estate planning, or they own properties within partnership, and there's a lot of vesting. They might want to consider changing title.
Right.
If they go their separate ways.
Yeah.
They bought it, for one purpose. They've owned the asset for a number of years. Maybe the siblings inherited the property. Things change. So kind of walk us through just what would somebody need to know about when they're doing some estate planning with vesting if they plan to do a 1031?
Yeah, so it's a good question. I mean, if you look at 1031 really on kind of a surface level, you think, oh, you've got 45 days to identify, another 135 days after that to close. You got to buy something equal or greater. You got to reinvest the proceeds. How hard could it be, right? There's lots of little gray areas where people kind of get tripped up, whether it be a partnership issue, right? So in an exchange, we always say it's taxpayer over title, right? So what we're looking at is who the taxpayer is in a transaction. So who's the actual one that's filing the tax return? Is it the LLC that owns the property? Is it actually that you're on title as tenants in common, so the individual partners are reporting that property underneath their social security number? But when you do an exchange, you've got to make sure that that taxpayer remains the same. So if you and I own a property in an LLC, you and I actually don't own an interest in real estate, we own an interest in a partnership. And so certainly the LLC can do an exchange because they're the taxpayer. But if you and I want to go our separate ways, that's where part of the advanced planning comes into place. And especially in California, they, the Franchise Tax Board, really kind of takes an interesting look on, partnership issues. You really want to make sure that, if you're thinking about selling an asset, you are in a partnership, you want to make sure that A, you talk to all the partners, find out what their idea is, if they want to move forward or not. And B, if they do want to go their separate ways, or people want to do some different stuff, you need to really do some advanced planning to get that in place out in front of the transactions before it's been marketed for sale, to make sure that you don't get caught up in an audit.
Exactly. So there's a lot of times when we're getting ready to complete a sale and a 1031 exchange is going to take place, we've already went through and understood what the ownership's looking to do. If they want to exchange, what type of property they want to buy, what type of location, what type of investment they're looking for. But the vesting is something that we've seen to where they've gotten to the very end.
Yeah.
Just in the market, we've seen that to where, and then it kind of gets into a standstill. And they've gotten some, maybe they didn't get the right level of advice from maybe somebody they're talking to, or they make an assumption. But just going back to this point where if you own a property within a partnership, one person they want to go their separate ways, what would you recommend they do?
So there's a couple ways of dealing with it, right? So you've got these things called partnership divisions where you can divide the partnership into 2 sub-partnerships. It really kind of depends on what each partner wants to do, right? You can certainly, keep a partner in the partnership. Maybe that other partner is willing to keep in 1% and move forward in the name of the LLC. The key is to try to not change the taxpayer identification number right before you sell the asset. And so, advanced planning, when people call me up and they say, what's some advice that you can give me when you're doing an exchange? And I always tell them, 1, have advanced planning in place, right? Selling an asset purely because it's highly appreciated is not, it's like a recipe for disaster. And the reason is because, I get calls from clients that, this one client called me it's probably 6 months ago, and he sold this asset and he got, top dollar for it, and he's in an exchange and he's like, listen, I'm having a really tough time finding a replacement property. And I said, well, what's the problem? He said, well, everything out there is just so expensive. And I said, well, did you get a lot of money for the property that you sold? And he said, yeah, I got the top in the market for that property ever. And I'm like, well, did you think that everybody else's property didn't appreciate alongside yours, right? Everybody else's property is appreciating as well. So you'd really need to make sure that when you go into it, that you have a plan in place to make sure that you're trying to, accomplish some type of a goal, right? Are you trying to, reduce management responsibilities? Are you trying to increase your portfolio? Are you doing it for geographic reasons? There's lots of reasons why, and that's why it's important that really far out in front of a transaction that they really talk to you, your team, and say, okay, we're thinking about selling, and you talk to them about really what are you trying to accomplish by selling this asset?
Of course. Well, if we go back to that point, maybe this is, a specific, but I think this would resonate with a lot of investors out there. They own a property in a single entity LLC. Maybe their parents put together and they co-own it 50-50 with another investor that they knew. Let's say that other investor passed away and their kids inherited it. They want to cash out because they got a stepped up basis.
Right.
But the other 50% owner is like, I don't really want to cash out. I want to hold or do a 1031 exchange. How would you structure that? Is that easy to answer? One scenario, how you could structure that.
Yeah, I think you always want to look at the, and work with your tax advisor, right? So that's important to get their CPA involved. But I think in a scenario like that, you maybe, take the partners out of the LLC that want to cash out, make them a tenant in common. Keep the LLC on title for its portion of the property as a tenant in common. And if you need to add a member to make it continue to be a partnership, you can always add a member to that. It could be a family member or somebody like that, so that when the property sells, the partners that got the step up in basis, they're going to cash out. And the partners that held the property in the LLC, they'll go ahead and do an exchange and go forward with that. But the key will be that the LLC, the taxpayer identification number, is not changed. So the IRS or the Franchise Tax Board has seen this taxpayer report this property on their tax return, under the same tax ID number as an investment. Then when they go to sell it, they're going to sell it under that tax ID number, report the exchange under that tax ID number, and then report the new property under the same tax ID number. So that's, I think, the best way to accomplish it. Now, there are other ways of doing it as well.
Sure. And then is there any type of seasoning? Is there anything in the
I think in a structure like that, you don't need to season it. I think that if you are in a situation where you're doing like the drop and swap transactions where you're dissolving the partnership, deeding the property into like a tenant in common structure where each member, now the tax ID numbers have changed, I think in those situations you definitely want to season the property. I would say, probably a year is going to be suffice. Some tax advisors like to see 2 years. And the reason is that the Franchise Tax Board takes a position that, while the LLC may have held this property for investment, the individual tenant in common owners, because they immediately, let's say, dropped into this tick structure and then sold the property,
Right.
they held the property primarily for sale. And properties that are held primarily for sale don't qualify for under Section 1031, so that way, theoretically, you don't have a valid exchange. Now, California and New York are the only states that kind of run into that issue. The other states don't really audit those types of transactions. The IRS doesn't seem to have a problem with drop and swap transactions, but if you are in California, and most of our customers are, right, you definitely need to be cognizant of it. There's a recent case that came out with respect to it that came out on November 2nd that deals with it, so it kind of gives a little more validity to the Franchise Tax Board's position on that issue.
I see. Okay, that's really good advice. That's just it. You've got to make a plan prior to a transaction and get your vesting and structured and seasoned or not, depending. But it's really important to do these things on the front end before jumping in and putting your property in escrow.
Yeah, for your clients, you do a lot of business in Orange County, right? But, and you do a lot on the apartment side. But let's say you had a client that said, I want to sell my apartment in Orange County and I want to buy in San Diego, right? That's a different market, right? There's different parameters. There's different type of tenants. There's different kind of, rules as far as tenants go. And so it's important that they have that discussion with you so that you can kind of educate them on, hey, this is what the San Diego market looks like. This is, what area do you want to be in San Diego, right? When someone says, oh, I want to sell in Orange County and move to San Diego's a big area, right? There's lots of sub-markets within San Diego, right?
Yeah.
So it's important that you kind of, educate yourself on what you're getting into.
Absolutely. And approximately 75% of the transactions we complete involve a 1031 exchange, either a buyer coming in or a seller going out. So we've got to know the process. We've got to make sure we talk to you, make sure that all the T's are crossed and I's are dotted before a transaction gets put together. One thing that I hear that's common, a couple of questions are, when you go to sell a property, do you have to replace the debt or not?
It's always an interesting question, right? So you don't have to replace debt because you can offset it with cash. And so, the basic rules have always been buy something equal or greater in value to what you sold. And that's actually the net sales price after closing costs. So you can deduct things like, title insurance fees, escrow fees, real estate commissions. Mm-hmm. So you can back those fees out. You also have to reinvest all the proceeds from the sale. And if you do those two things, the debt portion just kind of works itself out because you can replace debt with cash, right? So if I sell an asset, let's say after closing costs, it's $2 million. Let's say I have $1.5 million of equity and I had a $500,000 loan. If I buy a property for $2 million, right, I reinvest my $1.5 million, one of two things is going to happen in order for me to close on that property. I've got to either, come out of pocket with $500,000 so that I can, buy the deal, or I got to get a $500,000 loan. But either way works. So you can offset debt with cash.
Oh, that's perfect. Now, what about a couple things? What about seller carry? We're getting more and more commonly asked, hey, will the owner consider carrying financing? Talk to us about, does that owner carry coincide with an exchange?
Yeah, seller carryback financing does not work great in an exchange. And I think it definitely has its place in real estate for sure. I think that you have a client that's, maybe you're getting older, you're kind of tired of managing real estate, maybe you don't want to go in passive real estate investments, you still want to sell, but you maybe don't want to pay all the taxes right now. You could take on a long-term note. Maybe it's a note over the course of 10 years, and where it's interest in principal, and you get a little bit of principal each year, and each year you pay a little bit of taxes. So the way that basically note works in any sale is that it's taxed as the principal payments are made. So if I carried back, let's say, a 5-year interest-only loan, right, at the end of 5 years, that's when I would be responsible for paying taxes on it. But let's go back to maybe that example where I sold my asset for $2 million, mm-hmm. and the seller of that property wanted me to carry back a $500,000 note. But let's say I didn't want to pay taxes on it. Let's say I wanted to, exchange the full $2 million, and I had money sitting in a bank somewhere that I could, basically loan the client. So instead of, loaning them equity from the property, at the close of escrow on the sale, as the seller, I come in with $500,000 like a lender, right? Get this $500,000 note, and then the $2 million goes over to the exchange company. I buy a property for $2 million or more, and then essentially I have not paid any taxes on the note. So we do see a lot of seller carryback financing deals right now. Sometimes it's short term, I have a deal right now that I'm doing where the note's only 60 days.
Wow.
So what's going to go on is the deal's going to close. The funds are going to come over to us as the exchange company. We're also going to be the beneficiary of the note. And they're going to pay that note off in 60 days. And then the client's going to use those funds that they got from the paid off note plus the funds they got from the sale and use it to complete their exchange.
That's creative.
Yeah.
So, okay, if we come across any more owner carries, we'll make sure we talk to you on that.
Yeah.
What about reverse exchanges? They're uncommon in a sense. You don't see a ton of them, but I feel like we might see an uptick in that part of the process. If an investor has the liquidity to acquire the property, the up leg first.
Yeah, the key obviously is you got to have them in a reverse, right? You're buying the property that you want before you sell the property that you have, so you have to have some liquidity to be able to complete that. I would say we're probably saw more than we've ever seen, kind of going through this latter part of the pandemic. And the reason was because there was such low inventory levels on the market. I would say in November, October, November, December of 2021, and January and February of 2022, our numbers as far as number of completed exchanges probably dropped the most I've ever seen in the history of our company. And it wasn't because that people were not actively looking for property. There was just no inventory that was available. Mm-hmm. And so because of that, it really did an upkick in reverse exchanges because people could, put themselves in a position where they were buying the property that they want before they sold the property that they have. Reverses are not as likely, right? We do, let's say as a company, we maybe do 150 to 180 reverses, a month. And as a company, we probably do, 2,500 to 3,000 exchanges a month. So it's a very small percentage, but for a client that has some liquidity and has the ability to do it, it's great because they never put themselves in a position where they're subject to paying taxes, right? Because the worst case scenario happens in a reverse. I don't sell the property that I have within that 180-day period. What's the worst case scenario? I just own both properties, right? So a lot of our bigger clients do a lot of reverse exchanges because they don't want to expose themselves to tax liability. I had a client, many years ago, like 15 years ago, they were in a very large transaction. It was over $600 million. They were about 15 days after they had closed on their sale, and their purchase blew up. And so I called them up and said, hey, are you going to go look for something else? And they're like, we're not going to find another deal that we can replace this with in the next 30 days. So that's why they primarily do reverses. But it's a great tool for your investors to use. They are more expensive than a regular type of an exchange. Reverse exchange fees can range anywhere from $6,500 kind of on up. Regular exchange fees for us run about $1,000. But it really kind of puts themselves in a position where they don't have to worry about that 45 days.
Yeah, you've got your up leg. That's the name of the game.
Right.
So that makes sense. Now, is there anything else that investors need to know that's worth mentioning? Anything you're seeing in the market or other things to recommend? Because this is a little bit more not the the 101 on doing a 1031 exchange. This is kind of the 2.0 kind of version, a little bit more advanced planning. But anything else that might spark something that investors need to know about doing 1031?
I would always say be aggressive early. When someone calls me and they say, what are the things you can tell me on how to make sure I have a successful exchange? Is that one, before you even think about putting your property on the market, go into it with a plan, right? Mm-hmm. What are you trying to accomplish by selling this asset off? And then two, be aggressive early in the transaction, right? In real estate, you've got inspections that sometimes need to be done. I mean, it's kind of embarrassing, but I had my own personal exchange fail this year.
Oh my gosh.
So I was buying an industrial building. I had one of my best friends is a lender, and he said, you have to get a phase one done on the property. And I said, okay, so phase one environmental report, right? So no big deal. So I go out and get a phase one done. So I go under contract. I'm like a week into my exchange on this deal, right? So I go under contract. Phase one takes like 30 days. So after the phase one's done, I'm like 35 days or so into my exchange, and the phase one comes back and says you need to do a phase two, and I'm like, oh gosh. So I'm just going to blow out of this deal, right? Because phase two is going to take at least 45 days, right? So I'm going to be way past my identification period. But the owners were really great people, and they said, we'll go ahead and we'll pay for it. And I said, okay, if you guys pay for the phase 2, because they're pretty expensive, right? I said, if it comes back clean, I'll pay for half. And there was no reason why that these sellers believed that it wouldn't come back that way, and I believed so as well. And then 45 days goes by, the phase 2 comes back. It doesn't even give me a remediation plan. It just says consult your attorney.
Oh boy.
So now I'm way past my 45 days. I don't have the ability to complete my exchange. And so it's important. You just got to be aggressive early, try to get inspections done early, right?
Well, let me ask you a question. Did you identify any other properties as backup?
I didn't.
Okay,
I didn't.
well, Greg.
Yeah. Well, here's the thing, right? So in the market that we were in at that time, I knew that anything that I identified was probably going to be gone, right? I mean, the only thing I could have done was call you up and say, hey,
True.
man,
that is a good point.
would you sell me one of your properties in the event that this deal
Anything
blows
good
up?
that you would want to identify would have sold.
Yeah, so that's why, in any market, right? So I've been doing this for 23 years. In every single market, the 45 days is always the hardest part, right? So that's why you got to go into it with the plan. I mean, I have a client literally closed and went on vacation for 3 weeks.
Oh,
He came back, he's like, I don't have enough time. I'm like, yeah, you went on vacation for 3 weeks.
We've gotten some of those calls where somebody had sold something off market, didn't really get it. They got a great offer, they got a great price. They call us, hey, what do you have?
Right.
I'm looking for X, Y, and Z, and there's really hard criteria to fill.
Yeah, absolutely.
So a lot of the times what we do, because we really can't, nobody can maneuver. Once you close, that's when the clock starts.
Right.
So most of the time what we do is structure a sale, a buyer's deposit goes hard, and then there's, let's say, a standard transaction would be, for an example, 60-day transaction. The first 14 days are due diligence period. The buyer's money would go hard, and then they would close 45 days thereafter. The seller, we would, in this example, and it's very common, we would get 2 30-day options that the seller can extend the close of escrow to find an upleg, because you can do that, you can exercise the 30, right?
Right.
And we're not starting the 1031 exchange clock. So within that period of time, we've got time to then, you've got a non-contingent buyer on your down leg. We can go out there and start looking and get ahead of it, and then ideally be under contract on an up leg, already went through due diligence, clearing the due diligence period, and then kind of timing the closing. And that's been a way that a lot, brokers.
So weigh yourself to buy yourself additional time, right? Mm-hmm. So I mean, the 45 days is the 45 days, right? Yeah. But that time clock doesn't start till the date that escrow closes on the sale. So if I can push that time clock back, right, the starting line, you just keep pushing it back with those 30-day options. Now, how often in a transaction are you able to get that earnest money release? So like, you see clients that, are able to get that money released so that they can use those funds to go shopping with. How often is that? Is there a size transaction that you typically need to get to where you can see those? Or
yeah, on some bigger deals, when you're dealing 10, 20, $30 million, it's a little bit more common to see money released, but I'd say, just guesstimating, we're probably 15% of the time a buyer's money goes hard. It's negotiated that it's released, and not just hard in escrow.
Right.
Typically, a lot of folks have funds that they use to put down their earnest money outside of the transaction to open escrow on the up leg, but there's some instances where they need the money released to use that. So yeah, not everybody that goes hard wants to release their money.
So that's a good point though, right? So the point is, like, if you've got a kind of a mom and pop, seller that doesn't have a lot of cash reserves, and it's going to need that's part of the advanced planning process, which is like, we need to know, A, that you're going to need some money to put on a down payment, right? And B, like, we've had clients where, they kind of rely upon that income to, help them on a monthly basis. And so I always tell clients, if you run into somebody like that who either one needs, this funds to live off of, make sure that you let them know, like, hey, like, there might be 180 days where you don't get rent. Like, are you okay not getting rent for 180 days? Can you, that's something, another advanced planning deal that I'm sure you and your team kind of talk about.
That's great, yeah, and that's why when I was going back to that structure of the options to extend, so we can time the close of escrow, we can find the up leg, go hard before we close, and concurrently close as tight as we can.
Right.
So there's not a lot of disruption in cash flow, but we need to have the front end saying, like, if you're going into a value add property, we need to know that there's not going to be day one cash flow, and we'll model that up. Or if we go into a triple net lease where it's a coupon clipper, you're going to be able to have that income stream sometimes much more sooner.
Right.
So one of the things when we do release, typically we have the document stating that the money's released subject to the ownership notarizing a grant
Oh, the deed,
sufficient enough to convey title before it's released. And usually that sometimes helps, things work out. But that's a really good point, and that's all part of the planning process. It's not just on the brokerage side, it's also on your side as well, making sure these transactions are successful. So,
what percentage of your deals where you're selling an apartment do they go back into apartments?
There's probably, it changed. So I'd probably say more than half the time they're going back into apartments. It was a little bit less than that.
Okay.
But there was a shift. There was a trend shift probably about 24 to 36 months ago. It used to be, I'll own apartments, I'll create equity, I'll get some cash flow, I'll create equity, and I'll do this until, I might want to 1031 exchange into a passive investment, net lease investment, where, I can go off and have a better lifestyle, or I'm not in the weeds running an apartment building. But that was probably more like 2/3 of the exchanges were going into net lease. And then it started to shrink down to about 50% of investors are going into outside of apartments, and probably 50% of clients we work with are staying in apartments. And we saw that where investors were exchanging out of state and going back into apartments, which was not necessarily the case for a long time. But they started to go into these other markets that were booming, and they wanted to get out of some of the legislation within California. But they still wanted to be a multifamily landlord. Right. So about half.
What type of challenges do you say would like if you're exchanging and you want to exchange into another market where you're not actively right there? I mean, what kind of challenges does somebody face in those kinds of situations?
There's all sorts, right? I mean, there's so many nuances that you're probably not going to know. I mean, there's a lot of times where investors exchanged out of state and they're like, I didn't really underwrite for the weather. Right. That's not really in my P&L in California, right? So I think what's really big, I'll just call out one market, a lot of equity exchanged into Phoenix. Yep. We have a great Phoenix team that's sizable to our team here in Southern California. They know the market, they understand the market, and a lot of them, we've had them investors contact that team and get the nuances, have an introductory call, talk about inventory, how many transactions are trading, what's the likelihood I'll have an up leg. Luckily, Phoenix has been a good deal volume market, but there's a lot of other nuances that you need to know about. So before we even start in writing offer phase, way before that, when we're running a concurrent process on selling a down leg, we're also vetting and qualifying the right brokers, the right markets, making sure. So there's all sorts of things that you don't know, that you don't know.
Yeah, I mean, it's interesting. People, really always goes back to advanced planning, right? It literally goes back to you have to put in the footwork before you even think about putting your property on the market. If you don't, you could really put yourself into a bad spot. And so, having the team in place here to sell it, it's great. But you also have teams in other areas, CB, largest brokerage company in the country, and you have teams on the ground, boots on the ground in these other places that can kind of advise your clients on. I bought a property in Texas, an apartment building. I had no idea, it's this huge property. It's got all this, acreage. Yeah, but you also have to water all of that. And the water bill is gigantic. So all of those things, if I would have probably talked to a broker in that market, I might have understood some of those challenges, but I didn't have that kind of a relationship. So I think all of those things really, you really got to kind of, figure it out.
Advanced planning. Yeah. Talk to management companies. We had one investor that sold a number of buildings in Southern California. This was early. This was 2015, 2016. And he identified some markets that he really liked out of state, but he didn't know them really well. And he would call the local police department and get inside track on crime. And he would bring up, hey, such 123 Main Street or such and such apartments, and they're like, oh, we get calls there all the time. So he advanced planning,
it's
right?
Important.
He didn't go under contract, fly out there, and then figure out that it's not a good fit. So I totally agree with you. It's making sure you got the right team. That's why we like to. Since we are a team, we can go and run all these things up the flagpole, making sure everything's the right way structured. Focus on an up leg along with the same time of getting the down leg ready. We don't do one thing at a time. It's all fluid.
Right. Yeah. Experience also plays a big factor. I mean, you've 75% of your transactions have been exchanges, And that's been over the course of 15 years, and it's been a lot of transactions.
It's been a lot of transactions. We really appreciate you because really from day one, if somebody needs to get a real understanding of what's going on specific to their situation, they
Right.
pick up the phone, call you.
Yeah.
You're there, you're a wealth of knowledge. So we just really appreciate everything you've done, our relationship for over 15 years.
Yeah.
And we look forward to keeping it going. And is anybody who's watching this video, are they free to reach out to you?
Yeah.
And
You know me, my deal is always about being accessible. My deal is about being accessible to my customers, being accessible whether you're a broker, you're an investor. Like when I very first kind of got started, there was a guy that worked for the title insurance company. We're owned by a big title insurance company. When we very first got started, one of the top guys in the country sat down and met with me. And when he met with me, he gave me his card and he wrote down his cell phone number on it and he wrote down his home phone number on it.
wow.
And this guy is a guy that's making, a lot of money. And I years later kind of went to him and said and he's a guy that'll pick up a phone in a meeting and say, hey, I'm in a meeting, I'll call you right back. And super accessible. And I said, why did you give me your home phone number? Do you give that to all your customers? He said, I give it to everybody. And I said, why do you do that? And he said, because I want them to know that I'm always accessible. And I said, well, how many people do you have that call you at the house? He goes, anybody that calls me out of the house is probably a customer I don't want to do business with. but he said, very few people ever call me at the house. Right now we're with cell phones, right? The good thing about cell phones is you can work anywhere. The bad thing about cell phones is we can work anywhere.
Exactly.
Right, but accessibility and being able to contact, even for you, if you're not available, you have a whole team in place, right? That people can call and get answers for. So I have a team in place. Same thing, they can call and get answers even if I'm not available.
Yeah. They don't want to hit the 1-800 number and start pushing buttons and waiting
Right.
for people want information right away.
Absolutely.
So that's how it would be if we were in a trade, right?
Yeah, for sure.
So
For
makes
sure.
sense. So thanks so much for sitting down, being here, going over everything. And I think the bottom line is advanced planning.
Yeah.
That's the biggest thing. We talked about some deal stories. We talked about some of the things that are important to know and do. But at the end of the day, advanced planning, call Greg beforehand and let us know how we can help.
All right, sounds good. Well, thanks for having me in.
Thanks for being here.
All
right, that's a wrap. If you would like to discuss one-on-one, we'll put Greg's contact number below, or feel free to reach out to myself or anyone on our team. Thanks so much for watching, and we'll see you on the next video.